All right, so with the Reserve Bank of India deciding to continue its pause on interest rate hikes, focus is back on home loan borrowers who have seen rate hikes in the last 1 year impact their home loan EMIs. But now that further rate hikes looks unlikely, at least in India, what are banks thinking about interest on home loans? We will see a reduction in interest rate for home loans going ahead. Let's answer all of these questions. We are joined by a panel of experts, Aparna Ramchandra, founder, director, rectifycredit.com, Chitrabhanu KG, SVP and country head retail assets and cards, Federal Bank, Abhinav Kaul, vice president partnership, bankbazaar.com. Good evening and welcome to the show. And we are going to help our viewers, especially the ones who are really struggling and hoping that there is no further increase in the EMI. What should be the way ahead for them? So Aparna, coming to you first. Repo rate unchanged at 6.5% yet again. This is welcome relief for home loan borrowers who saw a steep and big rise in their home loan interest rate with a span of, 10 months starting from May 2020 to Feb 2023, when RBI raised the repo rate by a total of 2.5%. Now, the question is, are the two consecutive pauses in repo rate hikes a signal for the end of the current rising interest rate cycle? Is there a chance of interest rate falling soon, or there could be a pause that we can see extending?
Hi, Kavita. Good evening. I am not going to get into the speculation as to what is going to happen, but I feel there is going to be what was going upward, I think, is now kind of here. So, if not this, at least here. So, let us assume for the home loan borrowers that they take this as their benchmark and plan their home loan decisions accordingly. So, I do not know whether, to answer your question, so I don't want to speculate. But I
the
would
discussion over here because we will just hold that answer of yours now, because I really want to lay this ground and help our viewers understand what's going to be the trajectory. Although nothing can be decided, things are really unpredictable. But Chitrabhanu, what is your analysis to the same question that I asked Aparna? Chitrabhanu, are you able to hear me?
Oh, sorry, I just lost you. Can you just repeat your question?
Sure. The question actually is that are the two consecutive pauses in repo rate hikes a signal for the end of the current rising interest rate cycle? Is there a chance of interest rate falling soon or the pause being extended?
I think that's the best guess for all of us. And that's what we hope, all of us hope for. Because one of the reasons why the interest rate was getting hiked, not only for housing loans, but across product lines, was because the inflation was going up. And we see that in the last few months, there has been some level of stabilization in the inflation rates. And we expect that the inflation should be at around 5.1% by the end of this financial year. So if we see that happening and a downward trend towards inflation, I'm sure that we will have the housing loan rates, all the other interest rates, etc., going down. That's something which the entire market is expecting. But again, as pointed out by the earlier speaker, we should not be speculating on that. This is something which we should expect and hope for.
But then how is the retail loan demand so far coming up? Is it still strong, or you've seen a dip in it?
Yeah, surprisingly, over the last 1 year, the overall demand for housing loans and in specific and housing loan in general, retail loans and housing loan in specific has been quite good. It has been quite buoyant in spite of the fact that interest rates came up by close to 2% over the past 1 year. So even now, during this financial year, overall, the demand for housing loans, the demand for the other retail loans has not been bad. It has actually matched the demand of what was happening the last financial year. So that's a very positive trend for all of us as bankers, and in that sense for the overall economy also.
Abhinav, what's the current strategy for all the home loan borrowers and people who are really struggling to, save the higher EMI amount? Because although it is a relief for now, but then how exactly are banks looking at it? Are they up for giving some kind of a relief? I think this question will be directed to Chandrabhanu also later on, but then after you, Abhinav.
Sure. Good evening, Kavita. So, what we've seen, like my fellow panelists also said, in the last couple of years, we've really seen, because of the repo rates going up, the interest rates have also gone up. in the last couple of policy decisions which have come out, the repo rate is flat. Now, the general tendency, and again, not speculating, but just from experience, what looks like that because the retail inflation is somewhere seems to be getting under control, not fully where maybe RBI would want it to be, but because there is some semblance of that normalcy coming in into that inflation, we've seen this repo rate getting stabilized. We may, if this trend continues, we may in the next 6 to 12 months even see it coming down, and with that the relief will obviously be there for the retail consumer as well. As for what the consumer should do now, uh, the welcome relief is that now that upward trajectory has kind of come to a standstill. For the next few months, we don't see this interest rate going up. And this again is like an individual decision. It basically depends on what is the stage of the loan of that individual customer, how many months on board are they, what is the kind of stress that they have felt, because EMIs have almost gone up by 15-20% compared to where they were 2 years ago. So there are multiple options which actually people can take up, like maybe refinancing their loans and going to other lenders who are offering maybe a smaller, a lesser spread. But again, even the banks are trying to do something from their end. So all the financial institutions and lenders, what we see is that they have kind of brought down their spread. So which earlier was roughly close to 3%, that spread we see is close to 1.9% or 2% today. So there is a collective effort from everyone, from the regulator, from the banks, and then obviously it's an individual choice of where a retail consumer is today in their journey on their home loan, that they will have to evaluate and move forward. Kavita.
How are you evaluating in your bank?
Sorry, I didn't catch that, Kavita.
So, Chitrabhanu, as Abhinav spoke about how each banker is trying to evaluate, what is the strategy now at your bank? Are you trying to give relief to all the home loan or maybe just loan borrowers?
See, there are two parts to it. One is on what do you call that? How do we ensure that the customer retains his EMI over a long period of time? So that's something we are supporting. Not only we as a bank, but I'm sure the entire institution supports the customers in that sense. So initially, what we have started off is when the interest rates increased, we increased the period of the loan for the customer so that his EMI is retained at that point of time. True, the interest rate would have increased, but the customer is benefited in terms of he having this to pay the same EMI at this point of time. That's something which we are doing. The second point is, the market is in that sense very competitive, and every bank has to live to that expectations of the customer. So sometimes we may have to look at some marginal improvements, but that's all dependent upon each bank. It depends upon what is his liability profile, what is his overall asset expectations, margins, etc. So it varies from banks, but it's been always that we'll have to live with the competition and ensure that we match, especially for a product like a housing loan. Every customer will look at what are the rates in the market available. And now it's much easier with having all these a lot of aggregators in the market. So it becomes much more easier to understand what are the rates which are better in the market, which is a better product available. Maybe a lot of banks have also offered products like OD products, which is similar to maybe wherein you can, even if you have extra money in your hand, this is an opportunity for you to put some money and ensure that your interest rates are kept low. So these are all opportunities available with the customer and some things which the banks have also given to the customer.
All right. So, Aparna, HDFC Bank has hiked benchmark marginal cost of funds based lending rate MCLR by 5 basis point to 15 basis point with effect 7 June. The lending rates have been raised from 10 years starting overnight to 6 months now, which means those who have home loan, personal loan and vehicle loans tied to MCLR will clearly be impacted. I want you to explain this impact to the loan borrowers and also the difference between MCLR and EBLR rates.
That's a very good question. Most of the loans today are linked to MCLR. Even when the customer asks for a fixed rate of interest, most of the banks today do not give that option. So reality is almost 80 to 85% or even 90% of the loans are linked to MCLR. So now your repo rate, every time there is a movement there, correspondingly your rate of interest for the loans also fluctuate, right? So in the current scenario, the repo rate, RBI has managed to keep it at the same. It has not, tweaked it either upwards or downwards. So, which is where the home loan rates are going to be similar. So now we have two scenarios here. Every borrower that is linked to the, MCLR rates has an option to go back, and most lenders on their own are today talking to the borrowers and saying that in the next 2 months we are going to be reducing the rate of interest because the our borrowing costs are coming down, so you will also be getting a better rate of interest. In case you do not get that, is where you have to go in for your balance transfer and all of that. So most, what I would, why I'm bringing this topic is most of the uh, articles that came out online right after this 7th June meeting of RBI was, everybody said, oh, this is the right time for going for balance transfer. You should opt for balance transfer. See, balance transfer is not a blanket solution for everybody, number one. Number two, it is not a free of cost situation, because you may end up paying something like processing fee, again, documentation and all of that. Though if your existing lender himself is willing to, if they are willing to relook at your rate of interest and give you a better rate of interest, I would suggest that you are happier continuing there rather than go through the pains of shifting to the loan. Yes, in scenarios where your home loan is not getting revised to the reduced rate of interest, there you can choose to do your balance transfer. So for to come back to your question, every borrower today, wait for another month, talk to your lender, see what they are offering you, do your homework, and then go back. Today, 9.5 on 10, when you go and tell your lender that I have done my homework, these are my options, can you match this? Like my other colleague said, they are going to be relooking and trying to retain you, because customer acquisition is becoming more expensive. Customer retention is all the more dearer. So all the lenders are going to be looking at you differently. Kavita.
One more aspect to this, Chitrabhanu, let me come to you with this. Any further increase in policy rates means that interest rate on home loan may hit an all-time high and touch almost double digit. Now, we could have a substantial impact on buyer sentiments and affordability, which in turn can curtail demand. Are you prepared for this situation?
I think as bankers, we should be ready for that, because so though we all hope and pray that it does not happen, but in case there is again a chance that the inflations can go up, etc., then the RBI might look at even a further hike, which I hope at this point of time, in what we see in the market, it may not happen. But if that happens, in this scenario, the banks have to be slightly careful also, because you get a customer at a comparatively higher rates and the EMIs are comparatively higher. The risk on the bank is also in that sense increased. So what will happen at that point of time is we will ensure that we give customers only who require this for a final, for buying a house for his own living. Maybe the investment requirements, etc., might come down a little bit. So those are certain cares I'm sure the banks will anyway take. So yes, to make the story short, I think banks will be prepared for that, and we'll be slightly careful, because margin is in that sense very important.
Abhinav, we spoke a lot on home loan, but then what about personal loans and car loans, which are also on a rise as per the rising demand?
Right. So, see, overall, because of the repo rates going up, right, we've seen the entire gamut of loans get expensive. And like we've been discussing for the last 15 minutes, everyone is kind of now keyed in to see what is the next step, how does the inflation pan out in the next 6 to 12 months, what does the RBI further decide on repo rates, and how that trend line would be. See, once we see that stability, like I said earlier, in inflation, the repo rates are sure to come down. Overall, the interest rates across product segments will come down once this happen, be it a personal loan or be it a secured loan like a car or a two-wheeler.
So far it's a pause, but then going ahead, if you're a borrower, if you have any sort of loan, you really might consider, at least the home loan, you might want to consider the balance transfer or refinancing your home loan. But then going ahead, it's good that if a loan borrower is prepared with the kind of expenses and their EMI planning. Thank you so much, all of you, for being on the show and helping our viewers with that today. On that note, we'll take a quick break, and post that, let's talk about your bond investment and how to make the maximum of the maturity period. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Bond investments generally come with clearly defined time frame. However, not many understand that one should be more focused on the residual maturity of a bond and not the tenure of the bond. But what exactly is residual maturity in bonds, and what is the importance of fixed income investments? Let's understand all of this with Ankit Gupta, Founder Director, Bonds India. Ankit, good evening and welcome to the show. Let's understand the maturity period in a bond. Typically, a lot of people don't like this particular investment instrument because there are longer lock-in time frame, and they feel that they don't have enough liquidity in there. But then what if someone really wants to park in their money in something which has a longer duration lock-in period or a time frame, and wants to get the maximum out of it?
So, Kavita, good evening. So when you talk of maximum out of a bond investment, there are three things which needs to be analyzed. Bonds are available at all durations, right from a 3-month period to a 35-year period. So depending upon what is the kind of requirement that you have in terms of investment horizon. So the residual period of a bond may range between 3 months to 35 years. For giving an example, there's a Government of India security which is available at a 35-year period. So if you are looking to really lock your funds for a very, very long time, you can go for that investment. There are corporate bonds which are available for an average time frame of 3 years to 15 years. So when you talk of time horizon or a residual horizon, bonds are obviously available for whatever duration you are looking from, right from 3 months to 35 years.
What is the difference between the complete maturity period and a residual maturity period? Are these two different things, Ankit?
Yes, when you talk of a complete maturity period, the complete maturity period starts right from the allotment of the bond till the maturity of the bond. When you talk of a residual maturity period, it is basically talking about how much of a time gap is left. So let's take of an example, which is any kind of an asset which has a maturity of 3 years. And if you're buying that asset after a year and a half, then the residual maturity stays at 1.5 years. So in terms of bond, a bond which has come out with an issue somewhere around, is saying 2020 with a 5-year maturity. So the total maturity period of a bond is 5 years. But sitting today in 2023, half the year is gone. So the residual maturity of that bond is only 1.5 years left now.
All right. So what is more beneficial, and how can you earn maximum out of these two type of maturity periods? How should you strategize it?
So when you talk of maturity period and when you talk of a residual maturity period, a maturity period is something which doesn't matter to you as an investor because it includes the past and includes the future. So for example, the bond which was issued in 2020, and if you are buying it today, the 3.5 years which is gone doesn't matter to you. So what matters to you is what is left in future and what are you going to earn in the future. So when you talk of a residual maturity period, that is what is important for you. And when you are buying an investment or you're looking for an investment in fixed income, what you need to look into is the time horizon that you're looking to park your funds for. So for example, if you say that you want to park your funds for 3 years, then you should look for a bond which has a residual maturity of period of somewhere around 3 years in and around time. So the best way to invest into bonds is obviously when you're looking into a residual maturity period, that is what the time frame should be to invest into these bonds.
And this will not apply to a longer term fixed income instruments like a PPF or a Sukanya Samriddhi? Ankit?
So when you talk of PPF or a Sukanya Samriddhi investments, they definitely offer a much higher return and a much good return as compared to what some bonds might be giving in as well. But then again, the only thing which we need to look into is a PPF comes with a 15-year lock-in and a Sukanya Samriddhi comes with a 10-year lock-in, right? When you invest into bonds and when you have a shorter time duration, then these might not serve the investment horizon that you are looking at. So So yes, they are very good investment horizons as compared to other papers on the similar duration. But however, having said that, when you talk of diversification into fixed income as well, there is a limit to investment into PPF and Sukanya Samriddhi. So for example, in a year, you can't invest more than a year, 1.5 lakh rupees in PPF and 1.5 lakh rupees in Sukanya Samriddhi. But beyond that, if you want to invest into, then fixed income is something which will come into play, and that is where you will have to get the investments done.
What are the kind of bonds that you can recommend to our viewers, and they have an investment option right now?
So if you talk of bonds obviously have a lot of variety, right from a AAA. So I'm talking of rating because AAA is something which the investors might not understand. So bonds have a lot of nuances which we need to play into. So one of them is obviously rating. Bonds rate between AAA till BBB category. So depending upon the kind of rating and the kind of tenure that you are looking at in terms of investing into bonds, you can expect a return of somewhere between 8% to 14% in various categories of bonds. So for example, if I'm looking at a very good, very safe name, practically risk-free on a AAA side with a PSU like a HUDCO or a REC or a PFC, the interest rate would range between 7.5% to 8%. If I go on a lower rated kind of a bond, which is like the second category on the AA bracket, the range would be 9.5%. And if I go on a next level, the range would be somewhere around 11.5%, 12%. So depending upon your risk perception, depending upon the kind of risk that you can take and the kind of tenure that you're looking at, you can easily earn between an average of 9.5% to 10% on any of the bonds that you invest into.
Looking at the interest rate trajectory right now, what's the duration that you would recommend for anyone to park in their money?
So if you are looking at a duration call, or if you are really looking at trading into bonds in terms of the duration or playing around with the expected fall in the interest rate, then definitely you should look at a horizon of somewhere between 3 to 5 years. That is a medium-term horizon. Why? Because if you see the yield chart or the yield of the GSEC, there's an inverted yield curve. The short-term yields are much higher as compared, are almost on the same rate as a 10-year paper, right? So when you're looking to invest into a medium-term bond and in the falling interest rate scenario, that is what we are perceiving in the next 1.5 years. The bonds in 5 to 6 year range would give you a decent return along with a bit of a capital gain going forward in a year and a half.
What are the taxation or what's the tax implication when you invest in bonds and in such kind of fixed income, longer term investment instruments?
So when you talk of taxation structure into bonds, there are two things which we need to analyze in bonds. One is obviously the regular interest income that we earn in. And the second is obviously if you are looking to sell the bonds in a way wherein the price of the bond has risen up or risen down, whichever way it is. So when there is an interest component involved, the interest is taxable at the same rates of the taxation structure of the SSE, which is 10%, 20%, 30%, depending upon which income tax slab you fall in. When we talk of a gain which is beyond a year, which is a price gain in terms of the price of the bond, then this is taxed as a long-term capital gain, which is obviously taxed at 10% without indexation and 20% with indexation.
All right, so that was all about bonds and how can you make the most of it and look at residual maturity. Thank you so much, Ankit, for being on the show and helping.
Thank you, Kavita.
We will slip into a short break, but then post that, let's get your portfolio queries answered by our financial planner. And also, if at all you're someone who is looking for some guidance, you can send us your questions on our WhatsApp number and email ID. See you after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are a plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Amol Joshi, founder, Plan Rupee Investment Services. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Amol, good evening and welcome to the show. We have our first viewer online, Santosh from Bangalore. Hi Santosh, good evening. How are you doing today?
Thank you. I'm doing good.
So you want to know about government-backed bonds such as UPPCL and APSPL, and you want to know if they are a better investment instruments than mutual funds, that too for a longer period time frame. Is that right?
Yes, right.
So far, have you invested anywhere?
Yeah, I've invested in UPCL and APS.
You have already?
I just wanted to know, is it good to further invest over there itself because it's a 10-year bonds which has
Sure.
been issued.
Sure, sure. Any specific reason why you are looking for fixed income instrument and you don't want to go to something which is equity related, like equity mutual fund, or you do have a portfolio? Is it?
I do have a small portfolio.
You do have a small portfolio?
But this is both. Yeah, but I felt it's always a risk-free investment over here and a guaranteed income for the next 10, 12 years.
Okay, okay. Okay. All right. So we will explore this investment option and also if there's something better in fixed income that you can opt for. So Amol, could you please explain us the kind of investment he's talking about, UPPCL and APSPL, for all those investors who do not know about these government-backed bonds? How would you like to explain?
Sure, Kavita, glad to be here. And good evening, Santosh. Santosh has actually explained his thesis in one simple word or one simple line. He said that it is very safe. So obviously, all the government-backed, be it state government or central government, all the government-backed, government-promoted institutions are generally considered to be very, very safe compared to their private sector counterparts. So that decision or that thought process, Santosh, it's bang on. However, to answer your question whether I can continue investing in these, and you have mentioned two names, safety aspect is we have already discussed and it is out of the way. But let's come to another aspect of any sound financial plan, and that is diversification. Now, most of the times we think that diversification is only across asset classes like debt, equity, gold, international equities, etc. But within the given asset class, that is debt, I would really not advise to put all your eggs into one or two companies or all your eggs into one basket. There is a simple solution. You mentioned there is a 10-year kind of bond residual maturities there, the bonds that you have purchased. You can get mutual funds in fixed income segment or in debt segment from 1 week, 1 day, 1 week maturity all the way to 25, 30 years maturity. The only advantage that I think, or maybe 2-3 advantages that I can list over here, one is professional management of mutual funds instead of one individual, a layperson picking bonds. Number two is the daily NAV and daily liquidity that is available in a mutual fund format. And the third one, which I already mentioned, is the diversification. A typical mutual fund portfolio can have anywhere between 30 to 50, 50 to 70 bond issuers. Similar thing is about equity, but let's keep that for another day. So because of these three reasons, I would suggest, since you have already made some investments into these bonds, probably you would like to diversify into fixed income mutual funds for the advantages that we spoke of just now.
Santosh, is there anything else you want to ask Amol?
Amol, which is probably the closest, would you recommend actually the closest, which is the safest, probably the risk-free mutual fund, if you can also suggest?
Sure. Santosh, so I mentioned we have
state government bonds. And one more question, sorry, Amol.
Yes.
Is it 100% safe? Because nowhere I see any kind of this thing where it says it is 100% safe. State government bonds also. Is there a possibility that even a state government can go bankrupt?
Amol, we also have other caller on the line. Yeah. What will be the answer for Santosh? Amol?
Yes, my answer is so far, none of the government-backed institutions have defaulted, so it is considered very, very safe, Santosh.
Move on, and we have Sunita Balwada from Gurgaon. Good evening, Sunita. How are you doing? Sunita, hi. Can you hear me? Sunita? All right, we will try to get her back on the call. Are you there, Sunita? Can you hear me? All right, I think the call got disconnected, but then we'll try to get her back. Amol, Parag Parikh Flexi Cap, 10,000 SIP and Kotak debt hybrid. She's investing through SIP and she wants you to suggest a good mid cap and small cap fund, and she wants to invest 10 lakh. Do we have Sunita on the line? Okay. All right, so let's move on. I am not sure about the third fund that's written over here. It is an index fund, but then I don't have the AMC's name. Amol.
I think, Kavita, I think it is a Kotak fund. But anyway, do you want, for us to attempt this question?
Yeah, let's go on.
It's a Kotak hybrid fund, 5,000 rupees SIP, the third fund that is mentioned by
And
Sunita.
The second index fund?
It is Nifty 50, so it's nothing but a simple Nifty index fund.
All right, let's go on.
All right. So, Sunita, if you are listening to this...
I'm so sorry, Amol. I think we got Sunita online. Sunita, hi, good evening. Sunita?
Anji?
Hi,
Hello.
good evening.
Hi. Hi, good evening.
Thank you so much. You've sent us your question on the Money Show on ET Now. We are taking you live, and you have sent us 3 mutual fund information, which is Parag Parikh Flexi Cap. You have a Nifty 50 index fund, and you have Kotak Debt Hybrid. Is that right?
Right.
And since when are you investing in this, Sunita?
Actually, I just started investing just 2-3 months back.
Okay. And you got this recommendation from a financial planner?
No, actually, I just watched videos
Okay.
on YouTube only.
Okay. Okay. So you have 10 lakhs to invest, and
Yes.
so right now the SIP that you're doing of 25,000, is this a part of your 10 lakh amount, or is that separate?
Right. No.
It
This
is a part.
From this 10 lakh only. Yes.
Okay. Okay. And you want to invest this for how long? For how many years?
For at least 10 years.
10 years? Okay.
7 to 10 years.
7 to 10 years. And
Yes.
is it just the 10 lakh amount that you want to invest, or you are also willing to do an SIP once you invest all your 10 lakhs?
Actually, I've already started SIP in these 3 funds. And after 3-4 years, I'm planning to again add money in this only. So, and I just want to increase my funds also, because this is not all the funds I've included. These are just 3. And I don't want to invest more in Kotak, I think. Or what you suggest?
Okay. Any specific corpus you want to accumulate with this investment?
No, actually, my husband is a retired army officer. So we have our pension. I just want to just give some money to my children. Not specific, any specific goal. We have a house, we have everything. Just for investment purpose and just to give some money to my children.
Sure. Would you be knowing the name of other funds in the portfolio? Because right now we just have 3 funds information. Or you just want us to review these 3 funds, that's it?
To review these 3 funds and what all more funds can I add. And I just want to know one more thing. Is this right time to invest in mutual funds since markets are a little high?
Sure. I think that's a valid question, and Amol will come to it. But then, okay, Amol, first the choice of the funds. What do you have to say?
Right. So I would believe that these funds, Sunita has mentioned that she has not consulted any professional, and via listening to videos she has chosen. But from these funds, Sunita, these are equity-oriented funds. Even the third fund that you have is also in debt hybrid category. So that also has some kind of equity element in it. My first suggestion would be to remain invested for 7 to 10 years, as you have rightly mentioned. Your risk appetite comes out to be as a moderate to aggressive kind of an investor. Your initial question also, you asked us which of the mid-cap and small-cap schemes can you add. Let me answer that question as well. Within mid-cap category, you can look at Motilal Oswal Mid-Cap Fund. Within small-cap category, you can look at Nippon India Small-Cap Fund. One of the last questions that you asked was whether this is a good time to invest or not. Especially since you are going to invest in a SIP or systematic manner, I would say that any time is a good time or any time is a right time. It simply goes on to say that we do not know what market level will be 1 month from now, 3 months from now, or 1 year from now. SIP invariably will get you average of all the entire length of duration that you are planning to stay invested, or rather planning to invest via SIP mode. Let's talk about valuations also. You would recall that October 2021, we saw Nifty at around 18,800 levels. And today, 1.5 to 2 years later, we are at similar levels only. Within this time, while the market has remained at 18,000 or so, some dips and some rallies, but EPS or the earning per share of Nifty as a whole and all the Nifty components has gone up. That makes overall valuation cheaper. So in short, I would like to say that since we are looking at SIPs, you can continue with your SIP for as long as possible and remain invested for 7 to 10 years for within equity asset class to get the best results.
All right. Thank you so much, Sunita. I hope Amol has answered all of your questions. Is there anything else you want to ask him?
Thank you very much. I just want to know one more thing. This 10 lakhs, should I be investing in lump sum later on, or SIP is good for me?
SIP is good, but then Amol, what's your take?
Right. So if looking at your current breakup, you have 25,000 rupees of SIP. So you will take about 40 months to exhaust this 10 lakh rupees amount. So I would say this is slightly elongated duration. My advice would be getting over with your SIPs, or rather typically we call it, if the money is going from bank, it is SIP. You can probably put your money to good use. You can invest the entire lump sum into liquid funds. Liquid funds are non-equity funds. They do not possess any equity characteristics. They are not volatile like equity. Do the transfer from liquid fund to the intended equity scheme. That is called as an STP, or systematic transfer plan. I would suggest a maximum 6 to 9 months kind of STP. 40 months or close to 3.5 years is too long a time horizon to spread your to enter the markets, because see, your horizon is 7 to 10 years. If I take lower bound of 7 years, 3.5 years of SIP would mean that 50% of your intended horizon, your amount is not even fully invested. Because of that reason, I believe 6 to 9 months kind of a STP or even SIP would be a good choice.
Best, Sunita. We move on and we have Sushil Kumar online. Sushil Kumar, hi, good evening.
Hi, ma'am. It's Sushil Kumar speaking.
How are you doing, Sushil? Thank you so much for sending us your
ma'am.
question. You want to know more about ETF funds?
Yeah, ma'am. ETF funds. I want to know about how can I do ETF SIP in ETF funds.
Okay, you want to know the expense ratio and from which platform you can buy an ETF fund, right?
Yeah, ma'am.
Any specific reason, Sushil, why you are looking at an ETF?
Actually, I am having my funds in SIP in mutual fund also, but I want to explore in ETF also.
Okay.
That's why I'm trying to invest in ETF.
All right. We'll get your question answered. So, Amol, that's the beauty of something like a mutual fund, where you have all kind of investments, depending on your time frame, your risk profile, the kind of goal you want an investment instrument for. And here, when we talk about debt, or we talk about fixed income, or if we talk about even a passive strategy, in fact, index funds and ETFs are actually catching up, and investors are looking out for it. A lot of trend, or a bigger trend we saw in the large cap category, but lately a lot of interest in ETFs have come up. Are they really cost effective when we compare it with other categories of mutual funds in the passive category?
Right. Kavita, so let's answer your question first. Are they cost effective? So let me tell you that one of the most popular ETF, Nifty based ETF, has expense ratio of 6 basis points only. So I would say that this is as cost effective as it can get. And this is probably also the reason why somebody like Sushil Kumar, who already has investments in mutual funds, is planning to invest into ETF. So having answered your question, now let's go to Sushil Kumar. Sushil has started by asking, I want to know more about ETFs. So ETFs are exchange traded funds. These are types of mutual funds only. These are passively managed, as Kavita, you rightly said. These are typically benchmarked, or these ETFs mimic a particular index that you want to invest in, or the product that is available. Since these are exchange traded funds, you cannot buy them via a platform or via an application form like you buy mutual funds. But since these are exchange traded funds, you will have to essentially buy and sell them on an exchange platform. And what do you need to transact on an exchange? You need a demat and trading account. Sushil, another reason, your next question was how to set up an SIP. Traditional SIP that you are used to, since you are an existing mutual fund investor, that kind of SIP does not exist in an ETF. The simple reason is, in mutual funds, you can buy partial units also. By partial units, I mean, if your SIP is 10,000 rupees and NAV is 41 point something, then you will not get exact number of units. You will get the partial number of units as well for the additional amount. In ETF or in any of the stock, in India, you do not have partial stock ownership. So instead of buying a set number of rupees, you can buy a probably amount that is somewhere closer to that. Most of the demat and trading platforms do not offer SIP kind of facility, but since you have asked, a market leader, somebody like Zerodha, they do have a manual SIP where you have to enter the amount, and within that that amount, whatever exact number of units that you'll get, not partial units, obviously, I have explained that. That is the kind of purchase that you can make on a desired date, let's say 5th of the month or 10th of the month. So you can explore on these lines.
All right, Sushil, hope that your question is answered, and all the best for your investment going ahead. And on that note, Amol, thank you so much for being on the show and helping
Always
our
a
viewers
pleasure.
with their financial portfolio queries. And before I sign off, I'm going to leave you with our WhatsApp number and email ID where you need to send us your mutual fund related queries. 8657974571 WhatsApp number, the money show at etnow.tv. That's the email ID where you can send us your queries. Thank you so much for watching. Goodbye.